Hello, everyone. Once again, I am Raj Malhotra, ITPM Senior Trading Mentor. Now, it's always important to remember for you guys out there that it's not a stock market, but it's a market of stocks. And as I showed you last week on last time on my flash with my Bumble short, there are winners and losers no matter what the broader market does. Now, while I don't expect a big move for the index in either direction in the next few months prior to the election, I do want to highlight certain sectors, stocks, type of businesses that I prefer less. One sector in particular is retail and more specifically furniture. When you look at retail sales in June, it was flat, but it did beat the consensus estimate of a negative 0.3 decline. So that should be good news. However, if you look closer, it doesn't mean that it's good for all retail, because that meant that all retail was flat as a whole, which is not the case. In fact, if you look at furniture and home furnishings, that subsector badly lagged down 4%. Now that means that non-store retail like Amazon and Walmart, they were fine, and big ticket items, those companies continue to lag. And going forward, I expect more of the same, if not even more so. Just look at this week. A bellwether like Home Depot reported a weaker than expected sales outlook. They cited a cautious consumer, and and their consumers pointed to uncertain macro conditions as reasoning for their decisions. And let's not forget, more of what Home Depot sells is much more of a necessity than discretionary items like new furniture. And in particular, I wouldn't want to be have any long exposure to luxury furniture, and I think that's where I'd be willing to bet against. And one name in particular that stands out is RH Restoration Hardware. If you look at their last earnings report, it was an utter disaster. Stock was down 20% on weaker margins, higher expenses like advertising, and slowing sales. Quite a trifecta. However, they did reiterate their forward outlook, but they said with slowing demand and with a weakening in macro environment, I just don't see how things can get better. Another thing is if you look at RH's valuation, it trades at a premium valuation. And I just don't see how that makes any sense unless they blow out their next coming quarter. But companies with like RH that have slowing sales, weakening margins, and higher expenses, those companies don't deserve a premium valuation. In fact, even if they meet or even possibly beat their expectations, I could see a scenario where the multiple starts to come down a lot. Because you've seen that in higher end brands recently, in other segments of retail with premium valuations. The companies like Lululemon, LVMH, which is Louis Vuitton, Moet, they now trade at lower PEs than they did. And to me, there's no reason that RH shouldn't follow this. Just look at the words of the CEO last quarter. He called it the most challenging housing market in 3 decades. Now, I think that is hyperbole. I don't believe it's the challenging. I mean, I guess he never lived through the financial crisis, but I don't see how that market as a whole or dynamics have changed year over year or quarter over quarter. I mean, if you look at what RH is expecting, they're expecting their demand to increase in the high teens. And in my mind, increasing their demand close to 20% is aspirational at best and more likely delusional. Like, look at another company's comp. Look at Wayfair, which reported last week. Wayfair is the world's largest online furniture retailer. Now, granted, Wayfair's customers are probably a little more lower end compared to Restoration Hardware, and they're at a slightly lower price point. But they cited macro headwinds weighing on repeat customers. And that stock, Wayfair, is down 30% since earnings. And Wayfair actually beat all its important metrics. They beat their top line EPS, they improved profitability, and just barely missed on revenues. Reading from their transcript, their CEO stated word for word, customers remain cautious in their spending on their home, and our credit card data suggests that the category correction now mirrors the magnitude of the peak to trough decline the home furnishing space experienced during the great financial crisis. Adding that, even with the challenging macro, this was our best quarter of adjusted EBITDA and free cash flow generations in 3 years, clear evidence of our strict operating discipline. So if you look at Wayfair, they cited all the bad macro concerns, but they're actually doing a good job to help their profitability. On the other hand, Restoration Hardware is doing the complete opposite. The Restoration Hardware is not focused on operation discipline at all. In fact, completely opposite. What Restoration Hardware is doing is they're building large showrooms, galleries, and restaurants. Now, call me skeptical, but I don't see how a furniture company focusing on restaurants in their stores, how that business model is additive, even in good times. So even LVMH, like I said, which that's a bellwether for luxury goods, they cited a slowdown. So there's no way in my mind that Restoration Hardware can be immune to that. To me, there are just too many things working against Restoration Hardware, in my opinion, to justify this multiple. And if sales are lower, this thing could really come crashing down. They are also pursuing significant expansion in Europe, which to me makes little sense. That's not the growth area in my mind. That hasn't been the growth area for a long time. And looking at the balance sheet, RH's enterprise value is way too high. I mean, given the fact they have a negative free cash flow, and I don't see how that's turning around anytime soon. I'd be shocked even in 2025 that turns around. I think it's just a long road ahead for this company. So structure-wise, what I want to do is I want to set up a calendar, given I want exposure to September 12th earnings. And I think I'll probably trade in a range before that. So I want to set up a calendar that goes long September and short a lower strike in August that misses those earnings. So what I want to do is look in the options chain here. I want to pay $18 for the SEP 20th, 250 strike puts on a ratio. I'm buying those 2 times and selling one of the August 23rd expiration 240 strike puts for $4. So that would cost a total of $3,200 between if you buying 2, selling 1. And once that August expires, I want to turn that into a vertical. So say the August goes out worthless, and say I sell another 2 of the SEP 195 puts and collect another $3.50 per option, or a total of $700. With that, my net spend would be about $2,500. And should the stock drop from here all the way down to 195 on SEP expiration, you'd make about a 3.5 to 1 risk reward. Now that would be a pretty good payoff. And with all that money that you just made on that trade, maybe you could afford some of Restoration Hardware's massively overpriced furniture. With that, guys, I'm Raj Malhotra. I'll see you guys on the other side.